What's up, everybody? My name is Joe Brown. This is Heresy Financial. I've been doing research on the euro because I'm putting together a video on whether or not the euro is in trouble right now. And in doing research for that video, which I'll be posting at a later time, I stumbled upon some information that I had no idea about before. And it has to do with what caused the repo market to blow up in September of 2019. I had always assumed, based on all the information that was available at that time, that it was primarily due to a lack of cash in the system and didn't have anything to do with bad collateral, which is what caused the original repo crisis back that caused Lehman Brothers to fail. And I discovered some new information that, in fact, there might have been a tipping point issue with bad collateral in the system, particularly coming out of Eurozone banks, and I'm going to explain why. Ready? Let's dive in. Repo is short for repurchase, and it's basically like a pawn shop for the banks. If there's a bank that needs cash to pay for its expenses and it has collateral, it will go to other banks and it'll say, hey, I'll sell you my collateral for some cash, and I promise to repurchase that collateral from you at a certain point in the future. Back in the financial crisis, when that started to unfold, everybody had a lot of collateral, but it turned out it was all mortgage-backed securities. Lehman Brothers could not get anybody to buy the mortgage-backed securities from them. Therefore, they couldn't get the cash they needed, and they went under. Fast forward to September of 2019, the repo market rates had been fairly steady, and then suddenly repo rates spiked overnight, and everybody was fearful of another Lehman event, because if repo markets are spiking, the repo rates, that means that banks are not willing to purchase the collateral, give up cash in exchange for somebody else's collateral. So the big question was why? What is going on? Now, at the time, everybody assumed that it was simply a lack of cash in the system, that everybody was going and saying, hey, does anybody have any cash? We need some cash here. And so nobody was willing to, at the regular low rates, give up their cash in exchange for collateral, because they were all trying to do the same thing. Well, it turns out that that might not be completely true. There was certainly a lack of cash and an excess of capital or collateral in the system at that time, but it doesn't explain why repo rates overnight suddenly spiked. It would have been more, it would have made more sense if up to that point, repo rates had been slowly creeping up as cash became more and more scarce in the system. But that's not what happened. In fact, there was a tipping point overnight. Repo rates spiked. And I stumbled upon this information from Alistair McLeod, put it together on goldmoney.com. He was talking about the European Central Bank, the ECB, and how they've been lowering their interest rates further and further negative for years. Take a look at this with me. In July of 2012, the deposit rate went to 0%. 2 years later, in June of 2014, they pushed it down to negative 0.1%, and then later that year down to negative 0.2%. Over the following years, they moved to 0.3%, negative 0.4%, and then finally, negative 0.5%, and look at when that happened. September of 2019, which coincided with the repo market blowing up, the exact same day that the transfer of Deutsche Bank's prime dealership to the Paris-based BNP was completed. This means that the repo rate spiking in September of 2019, almost breaking repo markets, likely didn't have to do with the gradual accumulation of collateral and the gradual running out of cash in the system, but it had to do with a major player with counterparty risk seeking cash and the other players not wanting to touch the risk of that extra risky capital. Now you might think, well, if this is true, then you would have to look at Deutsche Bank's collateral. You would have to wonder, do they have bad collateral? Is their balance sheet particularly risky? And take a look at this. If we look at right now, and it's been worse, it's been better than this, but right now, Deutsche Bank, their market cap to balance sheet ratio is 1.9%. To put this into perspective, let's say you have a company like Amazon. That Amazon, let's say, I know they have a lot more, but for sake of simplicity, let's say they have 100 warehouses that they ship stuff out from. Let's say that the market cap then of their stock is so low that if 2 of their warehouses burn down, That is worth their entire market cap. Their losses from just those two warehouses burning down means they lose so much money that it's the exact same amount of money as their entire market cap is worth. All of their shares multiplied by their share price. Now, for Amazon, you would look at that and you would say, well, that means that that company is at a discount. It's priced below its liquidation value. They've got assets. If they went bankrupt, they'd have assets to liquidate and it would be worth more than what you could buy their stock price for, which means it's a great deal. But banks' balance sheets aren't like warehouses full of tangible goods. Bank balance sheets are full of assets and liabilities that are supposedly offsetting each other, which means that if the assets or liabilities on their balance sheet do unexpected things and they have unexpected losses, they could very easily have unexpected losses that exceed 2 or 3 or 4 or 5 or 10% of their market cap, and you wouldn't have an offsetting amount of assets like you would in warehouses to compensate for that. You'd have a real wiping out of value just based on how leveraged they are. Because keep in mind, this is all based on how leveraged they are. It is a massive amount of leverage compared to the actual capital being deployed. And the very fact that their share price is so low compared to the size of their balance sheet means the market has recognized this risk and is pricing them at basically close to bankruptcy and liquidation levels. So as always, the big question is, what does this mean for us now? And to be honest, not much, because this is retroactive information. Looking at something that happened back in September of 2019 shines a little bit of light on that. But it does highlight something that I'll be talking about in future videos and that I've mentioned multiple times. I think this next crash, it's going to originate from a crisis out of the Eurozone. These banks over there are very, very fragile. Their balance sheets are very unstable. They're highly geared, highly leveraged in speculative investments. The market is pricing their market cap, their prices, their stock prices at a level that is so low that is pricing in much of the risk here of something unexpected blowing up for one of these banks. And the central banks, the ECB, is not in a good position in case some sort of crisis like this does unfold. And so that's the main takeaway for me, is that it caused what happened in September of 2019 to happen, which caused the Federal Reserve to step in, start unlimited or QE infinity, not QE, start expanding their balance sheet again. And I think this next crisis is going to make that look like absolute child's play, especially given the weakness of the ECB and the compensation the Federal Reserve will have to do to step in and absorb a lot of the blow. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.